Welcome to the Micro and Small Cap Equity Research Report. Training Module 1. Assistant Asset Analyst Level 1. This training module is presented to prepare you for the schedule of assignments necessary to complete the Equity Research Report. As an Assistant Asset Analyst Level 1, your contributions to these reports will be compartmentalized to the specific elementary functions predetermined for your level of analyst. The following two videos are selected as teaching aids for the material to be covered for this training module. Please review these videos until you become familiar with its content.
A stock is a share of the ownership of a company. As the owner of a stock, the stockholder, you have a claim on the company's assets and earnings. Suppose Steve is starting a company, Pies R Us. He needs $100,000 but doesn't want to borrow from a bank. Instead, Steve invests $10,000 of his own money and finds 9 other investors who are willing to invest $10,000 each. In return, he gives each investor a certificate that represents 10% of his company. Each certificate represents 10% of the company's assets: the building, the pie pans, and the baking materials, and 10% of any future earnings. After 1 year, the company is doing well, and the company's total value increases to $200,000. This means each share of the company is now worth $20,000. $200,000 divided by 10 shares. That's twice the original $10,000. The original investors can sell their stock in the company to other investors for a 100% profit. This is how stocks work. Stocks are bought and sold daily on the major exchanges.
Hello and welcome to another tutorial video. This time around, we're going to look at a topic that we've gotten a lot of questions about, namely, what is in an equity research report? I have a couple examples here on screen of the first pages of equity research reports, both real ones and then ones that we've created in our various financial modeling courses. So the usual question we get on this topic is something like, what's in an equity research report? Or can you share a sample equity research report? Or can you teach me how to write an equity research report? It's a very common question, and it's also a very common case study task. If you're interviewing for equity research groups, they will often ask you to write a short report or look at a company and then make a recommendation and then write a report and submit it to them. So we're going to go through it here and cover the key points. There are 3 main parts to this tutorial. First, I'm going to explain the difference between stock pitches and equity research reports. Then in part 2, I'm going to go through the 4 main differences in research reports. And then in part 3, we're going to go through a few sample reports and look at the typical sections there and see how they're structured. Now, you can Google search this term and find a lot of material online and other sample reports from real banks and other sources. So finding the reports is actually the easy part. The harder part is understanding the rationale and why a research report differs from a stock pitch and how it's structured differently. So that is what I'm going to spend the most time on here. Let's go into part 1 first and look at the main differences between stock pitches and equity research reports. So if you haven't already been through some of our tutorials on stock pitches and seen a few examples, I strongly recommend looking at those because this entire lesson is going to make a whole lot more sense if you already know how we recommend structuring a stock pitch for a hedge fund or an asset management firm. Normally, when you're pitching a stock, you have very strong views about a company and why it might be mispriced by 50%, 100%, or even more than that. For example, if you look at one of our stock pitches for Jazz Pharmaceuticals, it was trading at around $130 per share at the time. We thought it was undervalued by at least 50%. So we have a pretty substantial pricing difference there. And the idea in a stock pitch is to say this company is mispriced and misunderstood by the market because of reasons 1, 2, and 3. And then in the next 6 to 12 months, there are specific events, catalysts, that will make the stock price change in the direction that we expect. Here, for example, We name a few specific catalysts and point out how, in our opinion, they could push the stock price up by at least 50% in the next 6 to 12 months. The idea is to explain why your views of the company are extremely different from what the consensus thinks about the company, and how even if you're slightly wrong, you can still make money with your recommendations. So you're trying to give them a picture of asymmetric returns and point out that if you're right, there might be 100% or 50% upside. But if you're wrong, maybe there is only 50% or 20% downside or something like that. And in an equity research report, you will see similar concepts, but the difference is that it's a bit of a watered down version of this argument and this structure. I think you can understand that if you look at the components that go into a stock pitch versus an equity research report. So in a stock pitch, normally you'll have a company recommendation, the company background, your investment thesis, catalysts, valuation, investment risks and how to mitigate them, and then the worst case scenario and what you might do about that. So the overall logic is to say that we think this company's stock price will increase from $50 per share to $80 to $100 per share. Now we might be wrong, and if we're wrong, it might fall to around $30 to $40 per share. So there is more upside than there is downside, but since there is that downside risk, let's protect ourselves by buying put options around that level to limit our losses. So if the stock really starts falling, we can exercise those put options and reduce our losses. Now, in a stock pitch, the most important parts and the parts that you tend to spend the most time and energy on are the catalysts, the valuation, and the risk factors. You really want to establish why your views are so different, and if you are potentially wrong, what you might do to limit your losses. In equity research, you have similar points, but the distribution of time, effort, and space is quite different. So first off, in an equity research report, you're generally not going to have a section on the worst case scenario, but you will have something on these others: the recommendation, company background, investment thesis, catalysts, valuation, and investment risks. However, you will end up spending a lot more time on the company background and the valuation part than you will in a stock pitch. Valuation is actually important for both, so I would say you'll spend about the same amount of time, space, and energy in both forms of investment recommendations here, but you will get a lot more in the company background and industry background and data in an equity research report. One of the main reasons for this is because in research, you generally want to promote the companies you're covering. So you're not going to see someone go out there and say that the company's stock price is going to double or that it's going to fall by 80%, because you generally want to say that we think this company is pretty good and its stock price could increase, and therefore you, our institutional clients, should trade more, buy more of the company's stock, and then hopefully generate more in commissions for our sales and trading desks. Now that you understand the differences in terms of distribution and arguments made in an equity research report, let's go through the 4 main differences. And as we do this, I'm going to bring up some examples from our sample reports here, one for Jazz Pharmaceuticals and one for Shawbrook, taken from our fundamentals modeling course and our bank modeling course. The first major difference in an equity research report is that there is more of a focus on recent results and announcements. And you can see this very clearly if you look at the sample report for Jazz Pharmaceuticals here, where we weigh in on the company's Q1 results and what they're guiding to for fiscal 2014. That's the year when we originally wrote this report. So there is very much a focus on these recent results. And you'll almost always see this in the first page or two of a research report that just provides an update on the company. Now, in a stock pitch, you may still see something like this, but updates and recent news tend to be more important in short recommendations, where you are making a recommendation saying that the company's stock price may fall. Timing is essential in these short recommendations. If you're making a long recommendation and saying the company's stock price is going to rise, you tend to focus on longer term issues and fundamentals that aren't tied to timing quite as strictly. The second major difference in an equity research report is that it's very rare to see views that are extremely far outside the mainstream. Remember that before Enron collapsed a long time ago, 15 out of 15 equity research analysts actually rated it a buy. In case you've forgotten or you were too young to remember this, here's a report from Bear Stearns where a year or two before the collapse, they had this rating attractive on the company. And then here's another report from Goldman Sachs which was actually a month or a few weeks before the collapse, where they had this on their recommended list, and they called Enron still the best of the best, even though the company was about to collapse and go bankrupt. Now, to be fair, the 14 other analysts covering the company also thought the same thing and had buy recommendations as well. But if you look at buy-side analysis around Enron, plenty of people thought the company was going to go bankrupt and bet heavily against it. The reason this happens is because the incentives are different. Research analysts on the sell side at banks are not investing their own money, so they have very little motivation to go completely outside normal views. Now, of course, they'll always put their own spin on things and come up with something that is a little bit different from what other people think, but you're generally not going to see something quite as extreme as what a hedge fund manager or other buy-side analysts would come up with. The other consideration here is that if the bank publishes a report that's too negative or a report that's too positive and therefore lacks credibility according to institutional investors, then the company's trading volume could actually be hurt and the bank's commissions from institutional clients might go down. So whenever a bank publishes research, it has to take into account implicitly how it's going to affect trading volume in the company and whether or not its institutional clients are going to want to buy more shares and therefore give the bank more commissions. Another difference is that you will see a lot of references to target prices in equity research as opposed to valuation ranges. So a report might say that the company is trading at $50 per share right now, and we expect it to reach $75 per share in the next 12 months. You can see a few examples of this if you look at the report for Jazz Pharmaceuticals. We have the price at around 130 and a target price of 170. If you look at the report for Shawbrook, this is in British pounds now, but the price was 327 pence and the target price was 358 pence. Very exact prices. If you're wondering how this is possible, the short answer is that it's actually complete nonsense. Valuation is all about the range of possible outcomes. So you always want to look at a range of different discount rates, different growth rates, different multiples, and you want to aim for something like saying the company is worth between $70 and $90 per share. But you're never going to say the company's worth exactly $83.41. So this practice is actually completely ridiculous. And it's not just myself who thinks this way. Academics have actually studied this issue and found horrendously low accuracy in these forecasts, largely because equity research analysts have to assign some kind of target price rather than giving a range. I don't know exactly why they do this, but it is sort of just the industry standard practice. It's slightly better if they give several target prices and they look at different cases. This is actually the approach that we take in many of our sample reports, where toward the end, we have something like a bull case, a base case, and a bear case, and we give different target prices in each of those. So that's a slight improvement, but when all is said and done, you really shouldn't be doing that at all. You should always be looking at a wider range. And then the fourth and last major difference here is that the investment thesis, the catalysts, and the risk factors are all looser. And what I mean by this is that you will still see these in reports, but they are not quite as rigorously presented as they are in stock pitches. So in an equity research report, you might see a page or two that has the investment thesis, catalysts, and risk factors, and they'll mention a few reasons. They'll give a calendar of upcoming events that might influence the stock price. They might explain why you could potentially lose money by investing in the company. The difference is that if you look at a typical stock pitch, far more time and attention is spent on these sections. I'm just going through our pitch for Jazz Pharmaceuticals right now. We have many sensitivity tables with ranges. We consider different scenarios. We explain exactly how all of the factors that we list as catalysts will affect the company's share price. Whereas in equity research, you're never going to see that. You're never going to see a statement where they say something like, if they successfully launch a new drug, their share price could go up by 15%. Whereas in a hedge fund stock pitch, you will often see it tied that closely to the company's share price. Also, in equity research, these items are used more to support the overall recommendation rather than to form or inform the recommendation. So the analyst already likes the company. They think the share price is going to increase. And by the way, there are also these events that may further increase the share price. Whereas in a stock pitch, the whole point is to find those events. And if you can't find them, you don't really have a stock pitch. So those are the four main differences. Now let's take a look at some of these sample reports in a bit more detail and see the typical sections that go in and go beyond just how stock pitches and research reports compare to one another, but see how reports are typically structured. I'm going to share two examples, one for Jazz Pharmaceuticals and one for Shawbrook. You can get both these if you go to mergersandacquisitions.com/equity-research-report. Our approach is that we generally start with a hedge fund stock pitch and we create the model and the outline for it, and then we modify it a little bit to create a research report. So in this case, our recommendation for Jazz in the stock pitch was a pretty strong long recommendation because we thought it was greatly undervalued. We modified it to a mild buy recommendation in equity research. For Shawbrook, this was actually a pretty strong short recommendation. We thought it was overvalued by around 30 to 50%, and we modified it and made it into a much softer hold recommendation in equity research because you are very rarely going to see a sell recommendation there. So most equity research reports on page 1 start with an update on the company, a rating, buy, sell, or hold, or equivalent terminology, a price target, and then recent results. You can see this for both of the examples here. If you go to page 1, you see an update on their Q1 results, their guidance for the rest of the year. We have something on the catalysts, and then we explain our price target for the company of 170 down here. We also give the financial and valuation metrics and a brief snapshot of our projections. One issue that comes up is that if you are giving a specific target price, you also have to give specific multiples and DCF assumptions to support it. So here, for example, if you look at what we're saying, we give an enterprise value to EBITDA multiple of 20.7x, and then one for the next year, 15.3x. We state how they compare to the median for the set of comparables. And then for the DCF analysis, we give the exact discount rate, the exact terminal free cash flow growth rate, and then the exact implied share price. Of course, all of this is a little bit ridiculous because you should always be looking at ranges, but this is just what you have to do if you're naming a specific target price. The next part of the report is usually something like an operations or financial summary, and this explains how the research analyst or associate came up with the forecast. So for a normal company, you might see revenue by product, market share, unit sales, and average selling prices. If we go to the Jazz report, we can see the revenue mix by product, EBITDA and EBITDA margins. We can see one of their key jugs here, Xyrem, the revenue and the price per patient per year. And that's what goes into that section. If you look at the report for Shawbrook, this is a lot more industry specific because it is for commercial bank. So we have gross loans, loans by segment, interest rates, interest income, net income and the overhead ratio, and then regulatory capital ratios. So it just depends what industry you're in, but those are some typical things you might see. Now in a stock pitch, you might have a little bit of this, but generally speaking, all this is considered background information, and it's less important than explaining how your views differ. They assume that if you're pitching a stock, you know how to value a company and project its 3 statements, so you don't need to go into detail on every single last assumption. You want to instead focus on how your views differ from what other people and the market as a whole are saying about the company. The next part is valuation, which may look similar in both equity research and stock pitches, but the assumptions are quite a bit different, and you're going to see numbers that are quite a bit more extreme in stock pitches. In equity research, once again, you're more likely to point to specific multiples, such as the 75th percentile or the median multiple, and explain why they're the most meaningful. So going back to the Jazz report, we see that right in the beginning, we give the specific multiples that our evaluation is based on, and then we give the specific assumptions for the DCF. We do give the standard football field valuation, and we go through the other methodologies, but the difference is that in each case, we actually pick target multiples and use those to get to our target prices, so we're very specific about it. We don't view precedent transactions as meaningful here for several reasons, and then even in the DCF, we give our free cash flow projections, but then we state the specific assumptions that our specific price is based on, and even if we show a range of values, we are still sticking pretty closely to those given assumptions. In a stock pitch, by contrast, it's a lot more about the ranges, which is why if you look at the stock pitch for this company, we have a lot more emphasis on the sensitivity tables and the range of different implied share prices that we get. And then toward the end of an equity research report, you'll have the investment thesis, the catalysts, and the risk factors. And this is where the biggest differences emerge. In equity research, this part is more of an afterthought. The bank might give reasons why a company is mispriced, but they're not going to spend a lot of time and energy laying them out. Each reason is not linked to a share price impact, and the reasoning isn't too detailed. So it's pretty stark if you look at the contrasts here. If you go into a stock pitch, for example, we can make very specific statements and say something like, for the company to be overvalued, generics would have to enter the market in fiscal 2016 or earlier, or they would have to enter in fiscal 2017, and our annual price increase estimates would have to be incorrect by 50% or more. You are never going to see a statement that specific in an equity research report. Instead, when you get to this section, you'll see that the company mentions something about these factors, but they don't tie these factors to a specific share price impact. So they're giving all the reasons, but it's a lot more qualitative. And even in our bull, base, and bear cases, yes, we give different share prices, but we're not really linking directly our catalysts to these different cases. And then the investment risk section is here, but it's mostly there because if a bank is making a buy recommendation, they want to cover themselves and say, we're making this recommendation, but we could be wrong, and there are risks. And so if you invest money and lose money, sorry, but we warned you about it, and you knew about these risks in advance. Whereas in a stock pitch, these are a critical part of the investment strategy, because if you don't know what the risks are, you don't know how to protect yourself, and you don't know what your total potential loss is. So the importance of these varies tremendously between these two different forms of investment recommendations. To sum things up, here's what I would say overall. If you look at the Jazz Pharmaceuticals research report versus the stock pitch, the key differences are as follows. We give an intrinsic value of $180 to $220 per share in the stock pitch, whereas it's only around $170 in the report, and actually lower than that if you look at some of the other cases. So we're much closer to the company's share price at the time we created the report. In the report, in the stock pitch, we are much further off, and we have much more extreme views about the company. With catalysts, we name the catalysts and we estimate the per share impact in the stock pitch. 15%, 10%, 15%. In the report, we mention these, but we never assign specific percentages or dollar values to them. And then for the risk factors, we give a specific range in the report and say the worst case scenario is that the company's stock price could fall from 130 to 75 or 80 per share. So we recommend hedging with put options. Now, we mention these risk factors in the report, but we don't assign a dollar value. We don't estimate the share price in the worst case possible scenario, and we don't provide a hedging strategy. So those are the key differences here. To sum up everything we've been through, with stock pitches versus equity research reports, the main difference is the purpose. Are you investing your own money, or are you making a recommendation to clients so that you can promote a company and get more trading volume and ultimately more commissions for your bank? As a result of this difference, even though some of the arguments and portions are similar, you're going to see much stronger and more detailed and rigorous arguments in stock pitches. The four main differences are that you'll see more of a focus on recent events and updates in equity research. You will see more on target prices. You're going to see views that are less likely to be far outside the mainstream. And although you will see an investment thesis, catalysts, and risk factors in many cases, they will be a lot looser and less rigorous than they are in stock pitches. And then finally, we looked at the reports for Shawbrook and Jazz Pharmaceuticals and the typical sections that go into these reports. So hopefully you know more about this topic now, and you feel more prepared to read and understand equity research reports on your own, and possibly to write your own if you have to do so in upcoming case studies or interviews.
Lesson 1. What is a stock symbol? Definition, INVESTO, Pedia. What is a stock symbol, ticker? A stock symbol is a unique series of letters assigned to a security for trading purposes. New York Stock Exchange, NYSE. An American stock exchange, AMEX, stock listings have 3 characters or less. Nasdaq-listed securities have 4 or 5 characters. Symbols are just a shorthand way of describing a company's stock, so there is no significant difference between those that have 3 letters and those that have 4 or 5. Stock symbols are also known as ticker symbols.
Do you own stock in Coca-Cola or Pepsi or McDonald's or GE or Unilever or Chevron or BP and on and on and on? Do you ever wonder how to identify your company if you look it up in the newspaper or look it up on a website? Hi, I'm Roger Groh at Grow Asset. The way that we've all learned to do that is through stock symbols, meaning each company has chosen a group of letters to help identify the shares sold by that company on specific exchanges. Now, for instance, in Hong Kong, everything is in numbers. On the NASDAQ in the United States, typically there are 4 letters. So it really depends upon the country and the exchange that you're dealing with. But the key is each individual issue will have an ID. And you need to understand what that ID is in order to figure out what the value of your holdings are. So that's a little bit about stock symbols. Good luck, look them up. You can always go to Bloomberg.com, and on the very top there'll be a box that says symbol search. You can type in the name of the company that you're thinking about. Up will come a symbol. That's how you can find them. That works globally on Bloomberg. Hope that helps. I'm Roger Groh at Grow Asset, and thank you very much for spending time with me.
Using stock symbols for research. Stock symbols or ticker symbols for Fortune 500 companies are shown below. You will see the company name and the company symbol in letters. The company name is Amazon. The stock or ticker symbol are the letters AMZN. The company name is Google. The stock or ticker symbol are the letters GOOGL. The company name is Samsung. The stock or ticker symbol are the letters SSNFL. The company name is Coal India. The stock or ticker symbol are the letters COALINDIA. Next we shall demonstrate how to use these symbols in our research.
Building your stock portfolio. To build the research stock portfolio, you will use the ticker symbols emailed to your private Outlook email box. The portfolio shall be archived using Microsoft Money. Be careful to enter the ticker symbols into your portfolio accurately. This process will be demonstrated for you in the next slide. You may get to Microsoft Money from your private mailbox directly by selecting the MSN app, and then selecting Money from the list of options. Or you can access the website from the directions shown in this slide. The key steps are shown below. First, go to the MSN Money website. For step 2, click on the button Track Your Favorite Stocks, create your watch list. In step 3, enter your Outlook username and password to sign into Microsoft Money. For step 4, click the plus sign and then input the stock ticker symbol. Just remember, the company is identified by the ticker symbol. The ticker symbol must be entered with care. The next slide will show how to accomplish this process.